Welcome to another episode of the FitBucks Podcast. If you're watching on YouTube, welcome in there as well. Today, we're going to be hitting on a topic that affects something like 9 million people in this country now. And that's because they are on income-driven repayment plans for their student loans. And we're going to be talking about the tax bomb, more specifically, how to actually save for it and how does it fit into your financial plan. And some of you might not even know what it is. So I'll touch on that too. Okay. Now, before we jump into the episode, if you're watching on YouTube, be sure to hit the subscribe button and the notification bell. It helps you because it's going to give you notifications of when we put out new content. We put out everything from student loans to investing, financial planning, everything else. So helps you. It also helps us and the channel grow. So we greatly appreciate it. If you are listening on the podcast, welcome to another episode. If this is the first time you've listened to the podcast or watched us on YouTube, welcome as well. We're glad to have you guys here. How to jump into it. IDR Tax Bomb, saving for it. First and foremost, just a high-level, quick summary of what the IDR Tax Bomb is. If you're on an income-driven repayment plan, most of your payments are not going to be enough to even pay off the loans. So you're going to have part of your loans forgiven in 20, 25 years. Okay. Now, let's just say you have $100,000 of your loan forgiven. You don't have to pay the Department of Education that $100,000. But in that tax year, so 20 or 25 years from now, you have to claim that $100,000 as income. So let's just say you make 150 grand a year 20 years from now. That tax year, you don't just make 150 grand, you make 250 grand in my example, because you have to claim that $100,000 as income as well, which means you got to pay taxes on it. So let's just say in that same example that I owe 100 grand, let's just say I'm in the 35% tax bracket. That means that I'm going to owe $35,000 in taxes in that year. That's the way it currently works right now. So on an income-driven repayment plan, you have to save for the tax. Okay. Now, how do we go about doing this at FitBucks? Now, this is a culmination of what we've seen from a behavioral standpoint work for people, and it also is combined with what we see from a financial planning research that we've done that I've done personally for 15 years on what works. And it also combines it all with IRS tax laws and how you can take advantage of different loopholes and whatnot. So let's dive into the first things first, okay? We have what we call at FitBucks the required minimum amount to save, okay? Now, this is different for everybody. We have a tool at FitBucks that actually calculates this dollar amount for you. But what it does is it projects out how much you may owe, and then it tells you at a minimum, this is how much you need to save. We call that the required amount to save for the IDR tax bomb. Okay, we're pretty creative here. All right. Now, one thing I want to point out though, okay, tax laws change all the time. So that required minimum amount can change based on different tax laws. It can change based on your personal situation, like getting married, or maybe your income grew faster than you thought or slower than you thought or whatever it may be. So this is not just something that you set and forget for the next 20 or 25 years. You have to stay on top of it. That is why, if you're a FitBucks member, because I know a lot of you watching this or listening on the podcast are FitBucks members, we actually have a technology as part of our financial plan technology that allows you to link your accounts into your FitBucks profile, and it will tell you what that required minimum amount to save is, and if you're on pace to save enough, and if you need to make changes over now the next 25 years, okay? So if you're a FitBucks member already and you're on an income-driven repayment plan, be sure to take a look at that to make sure that you're saving enough. If you're not a FitBucks member, shameless plug, I don't know what you're waiting for, go sign up. Typical financial planners are like $3 grand a year. We're as low as $15 a month, actually, if you sign up for our annual plan. So go sign up. Technology, financial plan, so on and so forth. Shameless plug again. All right, back to the IDR tax bomb. Okay, now the required minimum amount to save. That's the key. Okay, once you have that amount, you have to figure out how to save it within your financial plan. That's number one. And number two is where to save it. So what type of investment account do you use to save it? Okay, so the first thing we're going to talk about though first is how does this fit into your financial plan? Okay, now those of you that listen to the podcast, watch this channel a lot, you guys are already going to know some of this stuff, but it's worth repeating and worth hearing again. Okay, if you're new, this is going to be the first time you've heard this. Based on years of research, right? Like when I was in wealth management, like working with like 50, 55-year-olds, 60-year-olds, and seeing how they miss their goals, I put together a bunch of research on how to easily organize a financial plan, how to easily implement that financial plan, so on and so forth. And we now call that research and all that information that I put together, we call it the FitBucks financial planning method, okay? And it all starts off with putting your money into 3 categories. And this is essential to making your financial plan easy, okay? The first category is day-to-day money. That's like your income and your expenses. The second category is money for future self. So that's like savings for short-term goals, it's savings for retirement, and it's also debt payments. The third category is risk management, which is basically insurance premiums that you pay for like healthcare insurance, life insurance, disability insurance, and all that type of stuff, okay? For the purpose of the IDR Tax Bomb, we are focusing on money for future self, okay? So when we are setting up a financial plan, what we first do is put on our income and our day-to-day expenses for our day-to-day money. And we also put in risk management, so like the premium expenses. And then when it comes to money for future self, the first thing we do is we put in quote-unquote minimums, okay? Now this is where it's important because of the IDR Tax Bomb. Okay, so those minimums when it comes to savings are like a minimum to get your employer match if they offer it in your retirement plan. A minimum of $50 going to a Roth IRA. If you're married, that's per spouse. Minimum towards your debt payments. So like if you have a car payment, mortgage, student loan, you pay the minimums. Okay, that's how you set up your plan first. When it comes to the IDR Tax Bomb, that required minimum amount to save, we consider that a minimum, i.e. it's a must. So like if we're doing a calculation and we tell someone, hey, like you have to save $150 as the required minimum amount to save for the tax bomb, that has to be included in there, okay? So typically what we do is we say, okay, we got to include that as a minimum. I got that. Now where do I save it, okay? So again, going back to the FitBucks financial planning method, we consider that a minimum that you have to put into money for future self. Now, where to save it, how to save it. We recommend putting it into an account that you're never gonna touch, okay? Treat it like it's something separate, which the Roth IRA is a perfect account for that, right? Because most people associate that with retirement. I'm putting the money in, I'm not touching it, okay? Now, the cool thing about a Roth IRA though, and the reason why a lot of times people don't think about saving this tax bomb in the Roth IRA is because you can't, quote unquote, take out the gains tax penalty free, meaning before 59.5, meaning if you have the Roth IRA, a lot of people think if you take money out of it before 59.5, you're going to be penalized. And that's not the case. Fully not the case, I should say. Okay, it's partially true. You see, on a Roth IRA, the money you put in, the contribution, you can take out anytime you want. The only time you're penalized is if you take the gains out. So let's just say for 20 years, you put in $120,000 into your Roth IRA and it's worth $500,000, and you got this tax bomb of $50,000 where your contributions were 120 grand. So if you took out 50, the IRS allows you to consider that return of your contribution. You're not penalized on that, okay? So like I said at the beginning of the podcast, this is all about like research and behavioral stuff, but also IRS tax code laws that take advantage of them. That's one way you do that, is putting the IDR tax bomb savings into the Roth IRA, okay? So going back to the FitBucks financial planning method, okay, where we have the minimums. Now, remember, I said the minimum towards a Roth IRA is $50 a month. And let's just say that in this example, I need to save $150 a month towards my IDR tax bomb. That means I would add the two together. So going into my Roth, I would put $200 a month into my Roth IRA. So part of that $50 minimum going towards my retirement, and then the 150 minimum is going towards saving for the IDR tax bomb. That's how we do that. Okay. Now, you might be saying, well, what happens if, as part of my financial plan, I've decided to already max out my Roth IRA? Then that's when you can do things like online savings accounts or taxable brokerage accounts. And again, we highly recommend like opening up an account that's completely different than everything else that you have and put the money in there and treat it like it doesn't exist anymore. Okay, and that's the categories that you can put the money in. Okay, now that's a required minimum. And as you guys know, with our financial planning method, we have two goals. One's the long-term goal where we are increasing how much money we're putting towards our future self category over time. That's our number one goal. The number two goal is short-term. So when we're building out our financial plan and we put all of our minimums in, we're going to have a leftover money. We call that our available funds. And at FitBucks, we say 100% of that available funds then goes to our number one short-term goal. Okay, that could be like buying a house. It could be saving for a down payment for a car, saving for a wedding, whatever that number one goal is, saving for a vacation, whatever it is. That's what you're saving all that available money for. Okay. Now let's just say you don't have another short-term goal, or your number one short-term goal is just investing and saving for the tax bond and just investing in general. Then all that available funds that you have, you put towards savings, and you do more than the required minimum amount to save for the IDR tax bomb. And that's like, if you guys have heard us in like workshops and webinars or just whatever it may be, you've heard me give out stories, for example, of new grads that we've worked with for a while, for like 5, 6, 7 years, that already have like $100,000, $200,000 saved. In their situations, their short-term goal is saving and investing and not doing other things like down payment for houses and all that type of stuff. And so they put more than the required minimum amount into savings. They did things like max out their Roth IRAs. They put more money towards like taxable investment accounts, so on and so forth. Okay. So just to recap the podcast and the video today on this episode, the IDR tax bomb, first and foremost, you need to figure out the required minimum amount to save. If you guys need help doing that, sign up, become a member at FitBucks. We'll make sure that we can help you with our technology, but also our financial experts can help set all this stuff up for you, okay? Number two, once you know what that required amount to save is, go in, set up your financial plan, put the money into the 3 categories, and say, hey, where am I saving this? Again, Roth IRA is probably the best place to save it. If you're already maxing that out, then go into other types of savings accounts like online savings or investment accounts. And then if you have no other short-term goals, save more than the required minimum amount to save. All right. So that's the episode for today. If you guys got questions, you know how to get back to us. If you guys got comments or anything like that, be sure to put them in the comments or questions. That's where we come up with ideas for videos. So make sure you drop those in the comments section. Subscribe, become a FitBucks member. We'll talk to you guys soon.